Good morning and welcome, everyone. Thank you for all joining the New York Fed for our first session of the year as part of our ongoing culture initiative. Our past webinars and recent podcast series have received so much positive feedback, and we're pleased to be back in this forum for another round of great discussion and sharing of ideas on this important topic. Now, since our last webinar, the financial services industry saw a major milestone. This past New Year's marked the transition away from US dollar LIBOR. Now, it was a long time in the making. In fact, already 900 days prior, I had been counting down the days until LIBOR's end when its risks to our financial system had already been well known for quite some time. And I do have this mug here that has the 901 days commemorating that speech some time ago. Now, the end of LIBOR was a long-awaited event. It was a big step in the right direction. Now we're 3 months beyond the countdown clock, but all the issues surrounding trust in our banking system did not simply disappear when we cleaned up the New Year's champagne and confetti. There's still more work to be done. And that's why it's been so important to us at the New York Fed to shine a spotlight on culture and behavior in the financial services industry and make it a key area of our focus. When we first embarked on our culture initiative many years ago, our objective was to restore trust in the banking sector. And today we'll explore where progress has been made and which areas are still in need of improvement. We'll consider the nature of trust, how the public perception of banks' trustworthiness has evolved, and what can be done to create and repair trust within organizations and with the public. Now, since the very first banks in existence, trust has played a critical role, and that's certainly true today. Like in any relationship, trust is earned and built over time, but can easily and swiftly be lost. There's so much to explore in this topic. By bringing together people to share their best practices and their challenges, the New York Fed hopes to play a role in offering solutions and opportunities for change. Now, we're fortunate to be joined today by an incredible group of panelists. They each bring their own unique perspective and experience to this conversation, and I'm really looking forward to learning from them over the next hour. Again, thank you for your participation and your engagement throughout these events, and to the many of you who have shared feedback with us. So now I'll hand over to my colleague Jack Gutt to introduce the panel and kick off the discussion.
Thank you very much, John, and good morning to all that have joined. I will ask our panelists to please turn on their cameras and their sound. In the interim, a couple of words. As John said, this is an exciting topic, an interesting topic, and a very broad topic. We're going to be looking at trust from a number of different perspectives, including what does it mean and why does it matter in financial services and more broadly. Trust is, we're going to be discussing a macro approach, public trust in institutions. And what does that mean? At its most basic, I suppose, we trust institutions to deliver the goods and services that we contract for, but that is not enough, and that's not the point of today's discussion. Trust has evolved to mean things like doing the right thing, whatever that may mean, treating customers and others fairly and transparently, but it's also about internal trust, the micro approach, and the trust that employees and others within institutions have in the institution and their colleagues themselves. But I will let the panelists talk about this much more effectively. So we will spend about 30 to 40 minutes in moderated discussion, then move to an audience Q&A. So if you do have questions, please add them to the Q&A box on the bottom right of your screen. We're lucky to have a terrific panel of experts to discuss this question of trust in banks and within them. I will start introducing them. First, Deirdre Campbell is the U.S. Chair of Edelman's Financial Services Sector. Deirdre partners with financial services companies around the world to evolve their communications and marketing. She is an advisor to C-suites on issues such as reputation management, fintech, innovation, business transformation, and global expansion. Deirdre also serves on the board of the Council for Economic Education, and she is a trustee of the Institute for Public Relations. Shailene Gupta is the co-author of The Power of Trust, How Companies Build It, Lose It, Regain It, with Harvard Business School professor Sandra Zucker, a thought leader on trust in organizations. She's also an editor at MIT Horizon, which seeks to advance knowledge of science and technology within the business community. She was previously a journalist at Fortune magazine. Shailene also taught English in Malaysia on a Fulbright scholarship and wrote a book documenting the history of the Malaysian Fulbright program. We are also joined by Per Hugender. He's a strategic advisor at SEB Nordic Corporate Bank, where he develops tools and methods to improve decision-making on complex topics, drive strategic progress, and influence organizational culture. Per has spent the last two decades exploring how organizations can improve their approach to innovation, strategy, leadership, and organizational culture. Per is a contributor to the World Economic Forum, and his articles on psychological safety and perspective taking have been published in the Harvard Business Review and Knowledge at Wharton. Finally, Jordan Thomas is the chair of SEC Whistleblower Advocates, a former assistant director in the enforcement division of the SEC and a principal architect of the SEC Whistleblower Program. He established the nation's first law firm and legal practice exclusively focused on SEC whistleblowers. Jordan is a pioneer in the field, having secured the largest single case SEC whistleblower awards in history, and he has been profiled in the New Yorker, New York Times, and on NPR's Planet Money. So welcome to our distinguished panel. We're very happy to have you and lucky to have such a diverse range of perspectives and expertise. So I'm going to kick it off with a very simple question that I know everybody is eager to answer. What is trust? How do you define it? And I think Shailene, we'll turn to you first, since you've written a lot on this.
Thanks, Jack, and hi everyone. A pleasure to be here. FRB NY is very close to my heart simply because at my first job at the Department of Treasury, when my boss drew out all the agencies we'd be working with, FRB NY was the only one I recognized. So great to be here. Now, when it comes to trust, there's a lot of sort of fuzziness, and people will say, well, I know what trust is when I see it. But when it comes down to it, academics define trust as our willingness to be vulnerable to each other or to an organization. And when you think about that, we tend to take that for granted in the West, but it's as simple as I had a friend who studied abroad in Asia, and she bought a carton of eggs, and when she went to eat them, she cracked one open and realized it wasn't an egg, it was a chemical. So every day, as customers, employees, shareholders, the general public, we're extremely vulnerable to organizations, and we have a limited amount of power to be able to tackle them if it turns out that they violate this vulnerability. But it turns out when it comes to trust, it's pretty complex. We tend to trust for more than one reason. We make this calculation based on 4 different factors. And the first and the most fundamental is competence. And that's an organization's ability to execute and to deliver. And this is something that the tech industry really nails. If you think about sort of Amazon or Uber and your willingness to just keep using them despite sort of feeling not so great, it's because they get the job done. But it also turns out competence is not enough. And there's 3 other elements. The next is motives. How willing is a company to protect our interests? We understand that they have to turn a profit and they have to survive, but what do they do with the rest of their power? Next is fairness. And that goes beyond just how do you divvy up rewards and points, but also how consistent are you? Does everyone have an equal opportunity? How do you treat other people? And then finally, there's impact. When you interact with an organization, the first calculus you make about trust is, well, how did that interaction impact my life, the life of loved ones? And an organization can get the other 3 elements right, but if the overall impact on your life is bad, trust breaks. And so every individual will sort of go through a combination of these and adjust up and down. But I'm going to turn it over to Deirdre to give us a more on-the-ground look at what trust is and how it works.
Thanks, Shailene. So for those of you who are not familiar with Edelman, Edelman is the world's largest communications firm. We've been around for about 64 years, I believe, privately held. We've been measuring trust globally for the last 22 years, and we do that in order to help our clients restore, build, and and create greater trust in their companies, among their employees, in their communities, and building stronger societies and capital markets. Our leader, Richard Edelman, started measuring trust 22 years ago because he saw you may recall, 1999, the battle in Seattle, where the World Trade Organization gathered to negotiate the new millennial round of trade negotiations, and behind closed doors with a lack of transparency. And very quickly, 40,000 protesters took the streets, what's turned into a violent situation. And Richard began to sort of wonder, like, what's going on there? So the Edelman Trust Barometer was then formed. It measures trust in business, government, NGOs, and the media, because we believe that those are the institutes of society that that move in one direction or another to form sort of how the societies are developing in general. We look at trust because we believe that while corporate reputation is the culmination of one's activities in the past, that trust is a leading indicator, because if you are trusted, people will buy your stock, defend you in a crisis, want to work at your company, refer you to a friend, and so on and so forth. We believe that trust is a business imperative. And so by understanding the dynamic of, do you trust, fill in the blank, this institution in your country to do the right thing, we begin to understand sort of a society's general views on the institutions that they expect to have the greatest impact on change. And so I'll be sharing some of that data in our conversation this morning.
Thank you, Deirdre, and thank you, Shalene. I'm wondering, maybe Per or Jordan, since you have a more inward view of organizations and the individuals within organizations, if you have a different take or a complementary take on the definition of trust and what it means to the individual employees within an organization.
Absolutely. Jordan, do you want to start?
Yeah, go ahead.
Okay, yeah, so the trust between individuals, especially when it comes to collaboration, that I focus a lot of my work on, is somewhat different. And I think when it comes to the trust that Deirdre talks about between individuals and our institutions, that can't be emphasized enough, how important that is for us to build. But when it comes to collaboration, I feel that trust is a little bit harder. And one of the reasons is this question: what is trust? There's actually so many definitions of what trust is in that context that there's one researcher, I forget the name now, that concluded, looking at, taking a macro perspective, looking at all the research on trust, she realized that there's so many definitions that it combines to create macro nonsense. And there was another researcher, he said that from reading all these reports, it's impossible to see if trust is actually a verb or a noun. So that makes it confusing. And I think that confusion is one of the reasons why I don't use the word trust as much when I help organizations with collaboration anymore. I focus more on psychological safety, but the definition for trust, it's fairly similar to what Shalene said, the more macro trust, but trust, the way that I define it, is a relationship that builds over time between two people based on if I'm viewed as competent, benevolent, and if I have integrity. And it forms over time when someone sees me act in different ways. So if I act in accordance, that they will think that I'm trustworthy. And the problem is that it's history-based, right? So it builds over time. So in most situations in work life, we haven't had time to build trust. So I'll get back to that later. So Jordan.
As a former law enforcement person, I tend to think about things in less theoretical ways. And I think about trust as action, in the same way that the best indicia of morality is the actions that we take in our lives. And so for me, in the whistleblowing context, I believe that an indicia of trust is people's willingness to speak up or take action about wrongdoing. I could go on and on, but I'll leave it there.
Thank you very much. I think that's going to be the challenge is defining trust, but I think there is some commonality among all of us and how we think about it. So I guess the next question is, why should financial services care about trust? And does it still matter in finance, given what's happened in the decentralization and the depersonalization of financial services? So I'm curious for your perspective, Shalene, first, and then maybe Deirdre, you can give us your perspective as well.
Yeah, sounds great. So I'm still a firm believer in trust, and backstage, Per and I were like fighting over this and going like, oh, what are the differences? But basically, when you take a look at the literature, and I realize the literature says a lot of different things, there are all these benefits that happen with trust. So just on the smaller team level, there was a study of NCAA basketball teams, and they found that teams that had the highest amount of trust in their coaches had the highest number of victories. And the teams with the lowest amount of trust in their coach had the highest number of losses. And they actually interviewed the players to figure out what was going on. And one of the players on the winning team said, look, once we trusted coach, we wasted less time fighting the directions, questioning, is this what we're supposed to do? We operated really efficiently and we were able to use our practice time better. So now when you translate this to an economic environment and to a business, there have been studies that show that trust in managers increases revenue. So there was a study of different hotel chains, and trust in managers increased revenue. But I want to say it's by 8%. Okay, don't quote me, but it increased revenue substantially. And then if you bring this out to the country market level, there was a study by the World Bank that looked at 29 different countries, and they found that a 10% increase in trust in the population was correlated to about a 1% increase in GDP growth overall. So that ability to sort of operate where you aren't asking too many questions, you're not worried what happens to my investment, what happens to my money, it just makes society hum along that much better. And it's crucial for financial services when you're handling people's money, which is literally the options that they have in their life and their resources.
Thank you, Shalene. And Deirdre, oh, I'm sorry, please. Where are we now? How is trust in financial services and in the banking sector?
Sure. So it's been a little rocky. We started measuring trust in financial services in 2012 as we slowly came out of the global financial crisis, and we saw a steady rise in trust globally for financial services and a steady rise in the United States. In 2016, the Edelman Trust Barometer absolutely foretold the coming populism movement, because we also measure trust between what we call the mass population, which is 85% of the world. The barometer, by the way, is 33,000 respondents in 27 countries. So pretty comprehensive. If we look at that 85%, which is the mass population, and then we look at the top 15%, which are top income earners in top quartile of income earners in their country, college educated. They tell us they read the business media. They're between 25 and 64. And to see the divide increasingly grow between those two, between the informed public, which are trusting of financial services, and to see the mass population just rapidly declining in their trust of institutions. And the problem that creates is a lack of access to the financial system. Trust right now across the world is actually up. It's in the trusting category. In the United States, it's down across every single subsector that we measure: banks, credit cards, crypto, digital advice, and so on and so forth. And the problem that's created there is if the mass population is distrusting of financial services, then they're not able to participate in financial gains that come with that: access to capital, lending for new businesses, for entrepreneurs, generational wealth transfer, for professional advice. The mass population tell us that they get their financial advice from friends and family. And so, to have greater percentages of populations participating in financial services, it's good for individuals, families, societies, communities, and the markets. So we hope to see more people engaged so that they have access to the critical funds to build their businesses and to protect their families. When you read these horrific numbers about, the average household not having enough money to cover a $400 emergency. I mean, that's a societal problem that the financial services industry needs to, step forward and actively address. And we see that happening. We also see in the barometer an expectation that the industry will step up and provide better access to financial services. During the peak of the crisis, we saw a big hike up in trust in financial services. I think that financial services was seen as an economic first responder with PPP. You saw in credit cards and mortgage lenders defer payments. You saw the auto industry give back premiums without even being asked, because they said, hey, you're not driving your car, you're sitting in your house. So a lot of that goodwill has sort of fallen off at this point. And so we look to help clients take actions, to your point earlier, Jordan, the actions that you must take that are proven to be trust building.
Thank you, Deirdre. And that's an interesting perspective that maybe I hadn't thought about, this idea of trust as a driver of financial inclusion, which is something we certainly care about. There's a whole segment of the population that is underserved, and maybe trust is a factor in that. So I did want to shift back. You mentioned it, Deirdre, but it's something to what Jordan said about concrete actions. You've all mentioned actually concrete actions that engender trust, whether it's internal or external. And our initiative is focused on culture, and culture within institutions and within the industry. And culture is defined by those actions, those observable actions repeated over time. So I do think there's some commonality here, but I guess it's a question for Jordan. Is how do the perceptions of these actions, these tangible actions, which are really about the culture of the institutions, affect the trust that the public and that the individuals have in the bank? So it's really, how do you think culture and actions really affect trust? What's the correlation there from your perspective?
Let me start by saying, in many ways, kind of banking scandals are like bank robberies. They're rarely one-man jobs, and they're almost always witnesses. And over time, I've come to believe that significant corporate wrongdoing was rarely caused by rogue employees, insufficient compliance resources, inadequate policies and procedures, or compliance personnel that lack vigilance, as is commonly thought. Ultimately, I've concluded that the most common cause of significant corporate wrongdoing is that organizations involved lacked a culture of integrity, and they did not encourage people to speak up about wrongdoing. And so to improve kind of the trust in banks, the first step to kind of getting healthier is improving the trust within organizations. And Edelman has looked at kind of the macro perception of the public relating to institutions. But in 2015, I sponsored and co-authored a study with the University of Notre Dame of financial service professionals in the US and UK, and the findings are deeply troubling. And I can tell you that they haven't changed much, but quick things you could take away is that 47% believed their competitors were engaged in illegal or unethical behavior. 23% believed that their colleagues were engaged in illegal and unethical behavior. 22% said they had firsthand knowledge. But where it goes to trust is they said that only about a little less than 20% said that they thought that their employer would do the right thing if they reported a top performer. They feared that they would be retaliated against. And it is this sort of thing that leads people not to report. And it's this sort of thing that, if it's not fixed, will leave responsible organizations and law enforcement professionals in a situation where they're like beat cops without a 911 system.
So just on that, if we could continue down that case, whistleblower cases, SEC whistleblower cases have been markedly up during the pandemic. And I'm curious your thought on why do you think that is? Is there something about the pandemic that gave people greater psychological safety to come forward, or what are your thoughts on that?
Sure. I think that there are a number of things, and depending on your perspective, it's the perfect storm. or it's the perfect kind of law enforcement moment. But the first thing is that the SEC whistleblower program has been increasing the number of awards that it's been paying out and publishing about, and the size of the awards. And so that's one factor. The second factor is the ability to easily document wrongdoing. I'm at my dining room table. People have been working at their dining room tables for the last 2 years. It's a lot easier to print out documents, take pictures of documents, and do other things that will help to report. But the biggest thing that I found, and I think it probably dovetails with PER's work, is that I have found in my work with whistleblowers that when the tie between the employee and employer is frayed or broken, particularly by retaliation for internal reporting, people feel empowered to report externally. And God help what happens to the corporation next. And in a pandemic environment, many people felt that their future was uncertain. Their industry might be uncertain, whether they'd keep their jobs. There's so much uncertainty. And in that, it led people to, particularly in the financial service industry, which is relatively cutthroat as it is, to begin thinking about themselves.
That's interesting. And from your perspective, what is the impact, or from what you've observed, really, of whistleblowing on future behaviors within an organization and relationships, especially as they relate to trust? What are the consequences?
Well, that's a huge question, but I'll give you a couple of thoughts. First of all, people don't report in a vacuum. They think and talk with people around them about whether they should report, and ultimately, when they do report, people ask them what happened. And too often, organizations don't communicate about what's actually happening. And the assumption for whistleblowers is that the company's not doing the right thing, which of course increases the probability they report externally. But it also, all the people who are asking them they're saying, I don't know, nothing's happened. And worse, sometimes they say I was retaliated against. All of that undermines the culture so that people are less likely to report on a going forward basis. And I tell responsible organizations that they should protect the whistleblowers, whether they believe that they're correct or not, because the consequences on their culture.
Yeah, if I could just build on that, our data shows absolutely, Jordan, that job loss is the #1 societal fear. 85% of the respondents globally tell us job loss, followed by climate change, hackers, losing my freedom as a citizen, and then coming in 5th, experiencing racism or prejudice. But I have a bit of a rosier picture for financial services employees. It's very interesting to me that of all the sectors that we survey, financial services is the least trusted sector every single year. We've improved by double digits over the last 10 years, but still at the bottom. However, when we ask the respondents of the barometer, do you trust your employer to do the right thing? It is the employees of financial services companies that trust their employer more than any other sector that we survey, at 81%. And it's also very interesting to me that while the trust barometer data has roiled like the markets have through the crisis, that trust in my employer number at 81% didn't budge. And so I think so we then say to clients, you've got a very strong team of brand ambassadors waiting to follow to your lead. So like, what are you doing about that to support that employee base? So just a different perspective on that.
Add to
That is
Dee's
interesting.
point.
I'm sorry, Shalene?
Just a quick add-on to Deirdre's point. So I'm a research associate at Harvard Business School, and so Sandra Sutcher and I have analyzed a lot of trust betrayals and breakdowns in companies, and what we often find is that it's tied to a breakdown in trust with employees. And a lot of times, in order to have a product or a service that works, that customers buy into, you actually need to have a very strong base with your employees trusting their employer, because at the end of the day, it's your employees who are delivering on the product and service, and they have to be there and present and feel like this is part of a greater mission, the work that they're doing.
Thank you, Shalene. And I did want to go to Per, because this is a natural segue to the work that you've done in understanding the factors that contribute to trust and psychological safety within banking organizations. And I guess the question is, one, are these interchangeable concepts, and what are those factors that contribute to psychological safety?
Yeah. So I think they're very closely related, but there's differences. That becomes more and more important. So while trust is a relationship that builds over time, psychological safety is an atmosphere that can form in any situation when people meet. So when we meet right now, even if we don't know each other, so we can't, per definition, trust each other, we can still create an atmosphere where Shailene can challenge me with her thoughts on trust, and I can say that I don't talk about trust anymore because it's turned out that it doesn't work as well. And we can have a fairly good conversation. So that's two different things, and we don't have to have trust in order to have a really good conversation. And in many situations these days, for companies, the really important, complex, strategic topics, they either come in as a crisis. So, there's a war, or there's a pandemic, or there's another crisis, and we need to gather people who have not had time to build trust. But there's no time, to spend months creating trust, and then will, work in an effective way. So we need to be able to work when there's no trust, or when trust hasn't been maybe broken, but we just haven't had time to establish it. And so thankfully, that old truth, collaboration is all about trust, turns out it's not true anymore. There's lots of research the last 20 years on teaming and collective intelligence that suggests that we can come up with great solutions, and we can make progress on the toughest challenges. But it doesn't come down to trust. It comes down to other things like perspective taking, turn taking, psychological safety. So the ability to actually just voice that important information. So yeah, they're different. And sorry, Jack.
No, please go ahead. Per.
I just wanted to connect back to Shailene's example of the basketball team, because I think it's really important for organizations and leaders to think about when is trust helpful and when might it be less helpful. So the basketball team is a great example, and you say, once we trust the coach, we don't question things, and then you say, things hum along, and that's really good. In some cases, you want things to hum along, and you don't want people to question. The topics that I work with and help organizations work with, the most important complex challenges where there's lots of rights, lots of wrongs, the world is changing. The key to progress is the challenge. The key to progress is to dare to do things that might make me look less trustworthy, to say that I don't know the answer to this question, or I'm the CFO, but I need help to understand this, or say, 2 weeks ago, I said we should go in this direction. We did. I now realize that maybe we should have gone the other direction. Things that makes us look less trustworthy. And it turns out lots of people hold back that information. And as a result, collaboration on those really important topics suffer. While trust is very, useful when you just want things to hum along. And, like effect was back before the world became so increasingly complex. But, in today's environment, I think we should look to the new research, because there's lots of research on things that are more important than trust. So collaboration does not come down to trust. Trust might be helpful, but it comes down to psychological safety, perspective taking, basic dialogue skills. Sorry, that was a long answer, but I feel very strongly about it.
No, and I'm sure our panelists are going to have some thoughts, but I did want to ask you a clarifying question. I guess um, when you talk about the absence of trust, this historical basis, I understand that, but you're not referring to active distrust, because I would guess that distrust, which is a whole other thing, would be an impediment to collaboration. That's not what you're referring to.
I wasn't when I was speaking, but I can build on that, because there's another trust, so not the one that builds between you and me when I see you act, but there's actually an instinctive feeling that I feel when I interact with a new person. And this has been ingrained in us through thousands of generations, that if that person looks similar to me, or actually similar to people who I've trusted or gotten along with before in life, or sounds like my dad or something like that, I'm more likely to trust that person. The more different than me, or people that I have collaborated a lot with, that person looks, the more distrust I will instinctively feel. So this is another trust than the one that I talked about before. So this is really bad news when inclusion of new perspectives, new competences, new individuals is key for our organizations to move forward. And it's really bad news if we think that lots of our most important challenges, we need to bring new people together, because that's the instinctive part. So there can actually, when we bring people of great difference, that I pick up through looking at people and just getting the first impressions, I can feel distrust. So actually, there can be distrust in the most important situations. So one thing that I really try to do when I work with teams, especially teams that are dealing with inclusions, to tell them that trust, with the feeling that you have, if you trust or don't trust someone, is instinctive. So please try to not think about that, or shut that off, because it's a result of thousands of generations of survival. It's not a result of this person's trustworthiness, competence, integrity. And then we can start looking at the stuff that really matters, which is, do I, in this new situation, dare to voice important information? And a lot of the time, it's the person that's the most different that has the most interesting information to voice. Sorry for going on, Jordan.
Jack, whether the listeners are on Team Shailene or Team Pear on trust versus psychological safety, I think one thing that I can share with them is that from a law enforcement perspective, we consistently find that organizations are like parents who always think their kids are great. And in reality, there's things aren't quite as good as they think. And so I think it's critical that people consider whether they're using the fine folks at Edelman or someone else to do an independent survey of their organization, so that they can find out what people actually think, not what you hope to think, what is in your model code of conduct, because consistently you find out that things aren't what you think, and that it's often worse than you think. And only with that knowledge can you then begin to, whether it's using the Edelman folks to help you message it better or fix things that are just broken.
Thank you, Jordan. I don't think there's any teams here. We're all on the same team, I assume. I do want to shift gears a little bit and talk about, once that trust is damaged, whether internally or externally, and this has been alluded to, it can be very difficult to repair. I think all of us have experienced that in our own organizations at different times. So I'm curious, what works in terms of repairing that trust, whether it's with the public or internally. And maybe Deirdre, we can turn to you on this. From your experience, what are some of the things that do work?
Sure, and sort of building on what Jordan was saying, it is the understanding what those trust builders are among the populations that you're trying to engender trust. So asking them, engaging them on what matters to you as an employee, or what matters to you as the consumer. When we ask, when in this year's barometer, in business was the most trusted of the four segments, business, government, NGOs, and the media. Business was the most trusted. And when asked what should business be engaging in to build trust, the number one answer was climate change, followed by economic inequality. We talked earlier about financial inclusion, workforce skilling, access to health care, and addressing systemic injustice. The piece on systemic injustice is obviously huge in financial services companies. And so we're seeing companies, take those actions like, eliminating overdraft, like, no fees, like, the fintech companies making it easier to engage. And in many ways, the fintech companies are engendering trust ahead of traditional institutions because they're seen as more welcoming and less part of a traditional system that has shut out perhaps the have-nots. But it's the actions that have to be taken, these kinds of actionable steps that you can then message around. To your point, you can't message nothing. You have to actually take the steps forward that are trust building. And often that's the voice of the CEO, is the CEO taking a position on societal issues. Some 5-6 years ago, that was a millennial thing, a millennial expectation. And in the last 3-4 years, we've seen that become, ubiquitous globally. So it's really engaging your audiences in meaningful ways that are transparent and that and bring them into the process of trust building through the actions that you're taking with them as individuals and in your communities and views on society writ large.
Thank you, Deirdre. I do have a follow-on, and I'd love to hear from Shalene and anybody else on this as well. But when you talk about the CEO and agree, obviously leadership tone from the top is something that's very important. But I guess one challenge of that, and love thoughts on this, is how does that actually trickle down to the day-to-day employee? If you look at an organization with 200,000 employees, you could find somebody at a desk. How realistic is the expectation that that individual is thinking about the public trust in the execution of their function? It could be the CEO certainly is talking about these things, but how does that become real for a frontline employee?
Is that for me?
Sure, and would love
Sure.
to hear Shalene and anybody else.
Well, Deirdre, I'll let you go for it.
Please,
think
please.
Do you understand the values of your company? Do you understand the expectations of leadership? Do you feel like they are making a difference in your life? And for financial services companies, I say, I do a lot of public speaking, and I say to companies, what you're doing every day when you wake up in the morning and do your job in financial services, you're creating an accessible system for people to participate in, and it's critical to the running of the world. And so the financial services industry and the infrastructure that you provide is essential to our economic well-being. And that's something to feel good about every day. And so that's just but understanding the mission of the company from the CEO and the values and the expectations of you as an employee. Do you understand those things? Do you embrace them? And do you feel good about them? And are you living them? Is one part.
Absolutely. I would completely agree with that. And I was actually just going to double back and tag on to Deirdre's excellent points about regaining trust, which is that we have this 3-step process that we came up with based on the research. And the first is simply that you've got to apologize. Whatever the issue is, you have to show that there's an awareness that there's a problem, that people have suffered, and that you're going to fix that. And the second part is accountability, that the leaders really step forward and they say, this happened on my watch, and we're aware of it, and we're going to fix it, and there have been consequences meted out. And then finally, you've got to fix the problem, whatever it was that caused the breakdown in trust. And this is frankly where organizations kind of make it or break it in terms of regaining the trust. And one of my favorite examples of this is the Johnson & Johnson Tylenol case. So this is probably really familiar to everybody, where it's the fairy tale of trust. Some Tylenol bottles have been tampered with. They're poisoning customers. The CEO of Johnson & Johnson says this is unacceptable, goes on this huge recall, fixes it, and everyone says, oh my God, Tylenol is over. But it's not. It comes back, and everyone is happy. What people don't really know about is the story of 10 years ago with Tylenol, where Johnson & Johnson's subsidiary was trying to cut corners and sort of going through lots of layoffs, removed a lot of quality control processes. So a lot of the bottles get tampered. Now, instead of going through the same process where they apologize, they offer these recalls, they try to bury the problem. And they actually do these secret recalls where employees go to stores and they purchase Tylenol secretly and try to just get it off the shelves without admitting to the public what's going on. And Tylenol just tanks. And so just because you got that process of rebuilding trust once doesn't mean you're going to get it right again. You have to go through the process of recovery whenever there's a betrayal and really nail it down.
Thank you, Shalene. I don't know if Per or Jordan, you have anything to add on this idea of rebuilding trust.
Per?
I mean, I work more, with the trust between people within the organization, and in those situations, I think there's two things you can do to rebuild trust. The first, if people aren't really working together, but they work close to each other, very similar to what Shailene said about what a company needs to do. You need to do that as well. Step up, correct whatever was wrong, and make a strong statement. When it comes to trust between individuals, I think a lot of the time we focus so much on building trust instead of letting people interact and work together and prove their trustworthiness over time, and instead focus on helping them to collaborate in a meaningful way and perform together. But it's two different things. And it also depends on what kind of a breach. Is it like Tylenol where you're actually poisoning people, or is it someone that kind of cut corners and you don't really trust that person? So it's very different, but in most situations, when it's not a huge breach, I would say more let people collaborate, but give them the best setting to collaborate in to regain trust.
Thank you, Per.
Jordan?
Deirdre, did you have something to add? I'm sorry, Jordan.
What we haven't talked about is Deidre focused on what that responsible organization can do and should do. And I think that there's also the interplay with external organizations and why that impacts the organization and the way that people view the organization. So if you believe that the FDA was a great cop on the beat, you might be less worried about Tylenol. But in the SEC context, I found two things that are very powerful. One is if the SEC with the SEC whistleblower program created a program that allowed for greater incentives for reporting and greater employment protections and the ability to report anonymously. That pathway increased reporting to law enforcement. But the benefit and how it impacted people within organizations is that now gatekeepers within the organizations, people who are aware of problems, will say, we have to do the right thing or it's going to get out and the SEC is going to get involved. So sometimes reinforcing the third-party organizations actually empowers people within organizations to get to that difficult third step that Deidre talked about.
If I may, Jordan, actually, I had a question for you because I was chatting with a regulator and he mentioned that from his point of view, regulators actually tend to trust that organizations won't do wrongdoing. And then when something happens, they're just like, oh God, and then they start writing regulation. What is it in your experience? Is there the assumption that it's going to be fine, or do you preemptively?
That is a great question. When I was at the SEC, many of us gave a significant benefit of the doubt to kind of credible big organizations, credible organizations. And when I began working in the whistleblowing space, I was shocked by what I was hearing. And that actually is what led to us starting to do surveys to find out what the core truth is. And unfortunately, the core truth is far less than what we thought when we were within the organizations. Again, it's not that Wall Street is bad, but that there are bad actors and not enough people speaking up about them.
On that happy note, I'm going to take a pause here. Thank you for that. I do want to open up questions from our viewers and listeners at home. We have some coming in, but just as a reminder, folks, if you do have questions for our panelists, please put them in the Q&A at the bottom right hand of your screen. I will start with some of the questions we have received. So this is for Per and Shalene, and I will raise the question. It would seem that increased remote working will make it harder to build trust amongst employees and employees with their firm. Do you agree? And if so, how should employees work to build trust in a remote environment? Very timely question. And anybody can jump in, please.
Yeah, first of all, I just want to say that Shailene and I are on the same team, on trying to come up with great ways to help people improve their businesses. So Shailene, do you want to start?
Oh, I was going to say, I'm going to kick this over to Team Captain Per, who studies interpersonal trust.
Yeah, so can you state the question again? Sorry.
Sure. It really is about the new sort of, let's say we're in a hybrid work environment, and the perception is that it might be harder to build trust among employees and between employees and the firm if everybody's not together physically.
Yeah.
So, what are the implications? What can we do? Do you agree with that?
I definitely, sorry. Do you want me to start, or do you want to start?
Go ahead. Yeah.
Okay.
Feel free.
So I definitely agree. I think it's a lot harder to build trust. And that's why I think we need to look at that old truth that collaboration all comes down to trust, and how important really is trust. And there's lots of other things that we can focus on in this setting that can help people to work together in an efficient or in a good way. That's not focusing on trust, and perhaps trust will build along the way, and perhaps it will be helpful. But I think that if we put a lot of emphasis on building trust in this remote environment, I think it's going to be really, really hard, because it's so different from the in-person environment. And since we have so much research saying that there's other factors that's more important to our performance than trust, I think the question in itself, I want to come back with the question, why would you focus on trust? Why wouldn't you focus on psychological safety or dialogue skills or perspective taking? Why would we in this case focus on trust? So yeah, that would be my question back. Shailene, what do you think?
All right, so catching the ball in the answer of why would we focus on trust, I want to ground us back in that definition of trust is our willingness to be vulnerable. And so in the pandemic, our realities have changed a lot, and people are now working from home. And you don't know what somebody's reality is when they're working from home. Are they dealing with kids, an ailing parent, a loved one who's vulnerable, a one-bedroom apartment, a roommate? In an office, there's sort of an equalizing going on in that everyone is there in the same environment and has that same ability. And gosh, I wish I had Deidre's ability to recall statistics, because I was just reading this study, and it was about how senior leaders felt quite comfortable about their COVID policies. But if you survey down below, going to Jordan's point of the importance of a third party, employees were not very happy about what their employers had done. And in actuality, a lot of senior leaders had not taken into account their employees' feedback for what they needed in terms of COVID policies, what was going on. And so, of course, trust is breaking down, because you are vulnerable to that employer who sort of may not understand what the reality is that you are dealing with while working, and who also doesn't necessarily have that perspective or that insight to simply just look into your home and understand this is the landscape that you're working with. And I don't know that you necessarily do want them to, because there should be this separation of private and professional, but we are in a different environment, and I don't know that employers have done the best job of really shaping that. And I'm sure Deirdre has amazing stats on what's happened during the pandemic.
I think that what's interesting, and I'm looking at this question here in the chat about financial inclusion and what role are fintechs playing to build that trust. And are people aware that many of them are not really regulated? And that's really, I think there's only like one online bank that's actually has the full faith and credit of the U.S. government. I think that the regulators, are trying to hurry along to create a more regulated environment for these companies. But they are. I heard a great quote a long time ago that said the problem with banks, and not to offend everyone on this call, that the problem with banks is that they're full of bankers, and that they were trained to be bankers and they weren't trained to be customer experience people. That the fintech people come in through the tech door, they come in through the customer experience door, and so it's a bit of a different mix. So I think the more that fintechs and traditional banking can come together to provide new alternatives with in a regulated environment, the faster we'll be able to move to address greater financial inclusion.
Jack, I would just note that I think that strategies relating to remote work depend upon the generation in which you're dealing with, because the younger generation is far more comfortable with and sometimes prefer the remote mechanisms that us older people who say, go actually to the person's office, pick up a phone. They don't understand that. And so I think that organizations have to think about the audience that they're and develop strategies to give them trust or safety based on the generation.
Sure, but I do think that the pandemic accelerated digital transformation in banking, because when people couldn't leave their house and they found that they actually could bank on their phone and the technology worked, I think that accelerated trust and it accelerated digital access for people that were used to walking. Even I learned to deposit a check with my phone during the pandemic, and that technology's been around forever, right? But I never stopped to bother to use it. I went to the bank.
I did want to, Per, I did want to go back to you, and I appreciate your comments, but I don't want to let you necessarily off the hook. So if we take the question as originally posed, is in this hybrid environment, which is, Shalene, you made some really interesting points, some of which are counterintuitive to me. But if we look at this hybrid environment where this is how we're communicating, how does that affect psychological safety? So let's not use trust in this case, but how does this affect psychological safety? Is it a greater impediment, or does it facilitate it? Or
I think it can go both ways. So with psychological safety is that willingness to take risk, right? It's a willingness to speak up in the conversation. And sometimes it could be, the really important breaches that Jordan is talking about when it comes to whistleblowing, but most of the time it's these small things that include risk. So if you facilitate a call like this, it's really easy to pull people in and out of the conversation. But if you don't facilitate these kind of meetings, it's really easy for me to zoom out and get disconnected. Mm-hmm. So what I encourage people to do, what I try to do when I work with teams, is to make sure that everyone's engaged by talking, doing small group conversations, always keeping people included, and always making specific time for individuals to speak. And I do that, doesn't matter if it's on Teams or if it's in real life, but to have that specific time when you have time to talk and you're encouraged to say the most important information, that helps psychological safety. That's one of the small things you can do. And I think it can be really effective on Teams, but if you don't facilitate the conversation, I find that people zoom out and conversations become a lot worse. I don't know what the rest of you think.
No, I think that seems consistent. I do want to switch over. There was a question that came in about generational differences that Jordan alluded to, but this is more, I think, for Deirdre. I think one of our viewers is wondering if there's a generational difference between how employees view their employers. That data that you cited earlier, are there generational differences in that 81% that see their employers in a positive light in financial services?
Yeah, I don't have the demographic breakdown as much, but we know that the expectation of the younger generations of their employers is much different. That we live in a world where traditional marriage is not what it used to be. Traditional religion is not what it used to be. And people really sort of live in their workplace environment. That's where their paycheck comes from. And there is a very high expectation that their company is working to do the right thing in society. And in this world of the great resignation, attracting the best talent is fierce. And so their expectation to work at a company that has their back and the back of this and is doing good things in society is where all of our clients are moving to, because that's just table stakes for recruiting and attracting the best talent.
Terrific. If nobody has anything to add, we can move on to the next question. And this really goes to a point, Jordan, that you made in response to Shailene, which is great that Shailene is helping me do my job. I really do appreciate it. No, but it's an important question. Obviously, we at the New York Fed, as part of the regulatory community, do think about this and care about this. But to what extent does trust in the industry or any industry reflect to their regulators, and what's the inverse relationship between trust in the regulators and how people may see or think about a particular industry, in this case financial services? I leave that for anybody. And I don't know if Deirdre, in yours, I know there is actually public sector institutions that are looked at, but I don't know if you've had a chance to look at how regulators are perceived.
Regulators get pretty poorly perceived, but in the barometer they get lumped in, I think, with politicians. And so I don't think that question is super clear. This is the first year that we ever asked, though, about trust in central banks. And trust in central banks is globally, the average is that central banks are trusted. However, they are not trusted in 2 out of the 5 largest economies. They are in the neutral territory among developed countries, and they are trusted only in developing countries. And the US is distrusted with Germany, Spain, Russia, and Argentina. But I think that there's an interesting dichotomy there, because the global trust in capitalism is down. People believe globally that capitalism as it exists today does more harm than good in the world, but not in the United States. So where the central bank is not trusted, capitalism is trusted. And globally, trust in centrally managed economies is down dramatically, but not in the United States. It's actually trusted in the United States. So I think that the respondents' perceptions of centrally managed economies versus capitalism versus central banks, it's sort of it's a matter of what hat they assign to those categories, I think.
In the Notre Dame survey that I mentioned earlier, we asked the question what the financial service professionals thought of the financial regulators, and only 61% thought that they were somewhat effective in, let me get the exact, were at least somewhat effective at detecting, investigating, and prosecuting violations. Now, that was in 2015, so maybe things got a little better, but I would tell you that I don't think that the view of financial service professionals on the ground is where law enforcement wants it to be.
So we did a few interviews of companies who were recovering, and something that came out as best practice is CEOs who actually sat down with regulators and put them at the table and said, okay, we're in this mess, we've got these issues and these violations. How do we work together to fix it? And we're really transparent about their timelines and their solutions. But I'd actually have another question for Jordan. Sorry, Jack. I feel like I love asking questions, which is, I'd be curious in your, what have been the best cases you've seen of someone dealing really effectively with a regulator? What is the platonic ideal, the best way to do it if you're an org?
Well, that's a big question. I'll tell you that the organizations that the Fed regulates, they're well represented by counsel. So they're kind of playing their best hand, whatever the facts provide them. So it's not I don't think it's a style thing, or it's more of do they ultimately clean up the problem? And Areas where organizations sometimes fail is that they don't actually hold individuals accountable, and or they don't ultimately fix the culture, which means that you have more problems. So certain institutions regulated by the Fed, have a cascade of problems in multiple regulators in multiple countries. And so even though they have very good counsel, they haven't fixed the problem of culture so that they keep having problems.
Um, Thank you. I guess one question I have for Jordan and for the panel is, how can we move from seeing trust as simply an enforcement matter, a legal matter, a liability, perhaps, distrust, and more of an asset? Like, how does that transformation happen, or what have you seen happen where it's less of a compliance issue or a liability or a leak or a enforcement matter, but something that's innate to the culture?
I feel like we're seeing big changes, quite frankly. I wonder if we had been studying trust about a decade ago, a couple decades ago, how well this book would have been received. At the moment, it's going down quite well, and I think it's because we've gotten to a point where we're seeing widening inequalities in business. We've seen a model where it's really been all about the shareholder, and people are not happy with that anymore. And they're saying that companies and institutions have greater responsibilities than just primarily making money. We have bigger problems that we need to fix. And as Deirdre was saying, business is trusted in a way that a lot of other monoliths are not, and we want them to take the lead. So I think by simply having this conversation even today, we're seeing a change in the atmosphere and we're getting there. But we need to really centralize this more in our decision making, where, when the question before might have been, how will this impact shareholders? And I realize it's not relevant to government entities, but how will this impact profits? It's how will this build trust in the long term? What will this do to overall trust with such and such stakeholder?
I'm a little skeptical. Maybe it's because I deal with traffic accidents all the time, but I will say that I think that where there is progress, it's external. And I think it's the kinds of things that Deidre is pointing to, where it's no longer acceptable to be an organization that says, we're just trying to maximize profits for the shareholder. So I think where there is progress, it's not because people are saying, oh my God, it's so horrible that people are committing minor violations within our organization and are worried about our culture. It's more about we're worried about the perception of us, whether we're an oil company that now wants to focus on renewable energy. It's coming from a different place.
And a counter to that, maybe it is external, but you have to start somewhere. And the external part.
It's good. I'm happy. I'm just saying that I don't know if it's because people have come to Jesus, as we used to say in prosecution, on this issue. I think they're looking at it differently.
So one question I have about that is are there consequences? I think Shalene, you mentioned some data earlier where you could see some, GDP impacts on correlated to trust, but I do wonder sometimes that is there a tangible, can there be a tangible business case made for trust?
Absolutely. So The Economist did a study of major companies that had had a scandal, and they realized compared to their peers, these companies had lost quite a great deal of market capital and growth. And so if you think about Uber, um, Uber came out, it was doing wonderfully, and then it has this horrible year where there's just scandal after scandal, and then finally founder and CEO Travis Kalanick has to step down. So Uber started out with about 90% of the market share and Lyft with 10%. At the end of the year, Uber's market share had dropped down to 60% and Lyft was growing at twice the rate, and they offered the exact same service. And so you could say, you can make this argument as a skeptic, Uber still exists, we still use it. But it took a huge blow. And certainly, even today, if you talk about Uber, people get this look on their face, and that has a consequence.
Well, I think we're up on time. I think there's so much more to discuss. This has been a terrific conversation. I really want to thank all of our panelists. I'm going to turn it over back to President John Williams in a minute. But again, I want to thank each and every one of you. I want to thank everybody who participated and who sent in their very thoughtful questions. Unfortunately, we didn't get to all of them. And we couldn't even reach a consensus, which I think just points to the fact that there's a lot more to discuss on this topic, and it's certainly one we'll be keeping an eye on and our finger on. But thank you again, panelists, very much. And thank you to my colleagues at the New York Fed for helping to organize and put these webinars together. And thank you to everybody that participated. So with that, I will turn it over back to John Williams for final comments. Thank you all.
Thank you.
Well, thanks, Jack, and I couldn't agree more. This was a great webinar, great series of wonderful conversations on important topics, and I'd like to add my thanks to the panelists for a very stimulating discussion. And you're right, though, that this is not one where there's a clear answer or agreement on all issues. It was, very nuanced discussion around the various concepts around trust. And in fact, I think it'd be fascinating to take the tape from the event and create a word cloud, because you had words obviously like trust, psychological safety, integrity, competence, willingness to be vulnerable, and a lot of others. And these themes kept coming up in different ways, in important ways. A couple of things that I would just, I think are food for thought as we continue these conversations around culture in banking and thinking about trust and the related ideas. One is this issue of that Per brought up about the backward looking or history, really what he called history-based aspects of trust versus things that are more forward looking. And then, how when you put together a new team, people who don't know each other or haven't worked with each other before, how do you how are you successful at collaborating when you haven't built up trust over many years? And I thought the connection of that to remote work or hybrid work, that discussion was really interesting and very important for all of us who are working now in a more flexible model, where many of our colleagues, we haven't actually worked physically together over the past couple of years because they've been virtual hires, as we say, or they're working in different jobs or different parts of the organization. So I think that was an important aspect of it. There's a backward looking part. There's also the, when people first come together, and then how bias may come into play there. So the other concept that was really important here and tied into that was actions matter. Jordan emphasized that quite a bit. It's not just tone at the top and words. It's actually the lived experience and the actions that people take, and that's an important part of this. The last thing I would just mention is just this. I think that, again, a nuance here that I kept hearing about the importance of teamwork and collaboration, but also having diverse perspectives and having a challenge culture and making sure that you're being inclusive. So these aren't contradictions, but some examples of teams are really about a team with one leader and everyone follows the instructions, which can work really well. And the sports analogy was a good one for that. But there's also many other situations where you really want to have that trust that people can feel that they have that psychological safety to bring their views and perspectives and feel valued for doing that. And so I thought, again, a lot of really interesting topics for us to continue to think about and bring back as we continue these webinars and other events. So, I thank everybody for participating this morning. Looking forward to our future webinars and hopefully some in-person events as we continue the culture and banking work that we've been doing for many years. So thank you again, everyone. Have a great day. Stay well.